Tools and services. In this course, we will use several key tools and platforms. TradingView is used for analyzing price charts across global markets, including stocks, currencies, indices, and cryptocurrencies. A cryptocurrency exchange is used for trading digital assets and executing buy and sell orders. A crypto wallet is used for the long-term storage of cryptocurrency assets. An online stockbroker is used for trading traditional financial markets. A forex broker is used for trading currency pairs. Please note that some regional restrictions may apply. There are no referral links in this course. This video is created for educational purposes only. Market mechanics. It is extremely important to understand market mechanics and the psychology of market participants behind every action. You may often hear terms such as strong level, double bottom pattern, and similar concepts. However, the key question is always the same. Why does price react in this way? Why does a specific pattern suggest a potential rise or decline in price? What is the underlying mechanism behind it? Any pattern you use in your analysis must reflect the psychology of market participants and provide a logical explanation for future price movement.
Market participants. There are two types of participants in the market, buyers and sellers. Together, they create supply and demand. When demand is strong and available supply at nearby prices cannot satisfy it, buy orders move higher and absorb liquidity at higher prices. As a result, the price of the asset rises. When supply is strong and there is insufficient demand at nearby prices, sell orders move lower and execute at cheaper levels. As a result, the price of the asset declines.
A logical principle. Every buyer eventually becomes a seller, and every seller eventually becomes a buyer. It is important to clarify that this course explains market mechanics only. It does not encourage trading futures, using leverage, or engaging in any specific trading activity. Long position. A long position occurs when a market participant buys an asset with the intention of selling it later at a higher price and profiting from the price difference. For example, an asset is purchased at a price of $4,000 and later sold at $10,000. The profit in this case is $6,000. Short position. A short position occurs when a market participant sells an asset first, expecting its price to decline, and later buys it back at a lower price. In practice, this process is automated by the exchange, and no direct borrowing takes place between individuals. For example, an asset is sold at $10,000. When the price declines to $4,000, the asset is bought back. The difference between the selling price and the buying price represents the profit. It is important to note that the buyer who opens a long position eventually becomes a seller, and the seller who opens a short position eventually becomes a buyer. Both opening and closing positions have an impact on the market.
Let's talk about order types. The first type is a limit order. A limit order is a pending order that guarantees a specific price, but does not guarantee execution. In a typical exchange interface, you first choose the order side, buy or sell. Then you select the order type as limit. After that, you set the price at which you want to buy or sell the asset and specify the desired trade size, for example, 0.5 units. The total value of the order is calculated automatically. For example, if the current price is $10,000 and you place a limit buy order at $9,000, the order will only be executed if the price reaches that level and there is enough liquidity available from sellers. If the price does not reach the specified level, or if there is insufficient liquidity, the order will remain pending in the order book. Limit orders may also be filled partially. For instance, an order for 0.5 units may be filled for only 0.2 or 0.3 units. This brings us back to the key idea. A limit order guarantees the price but does not guarantee full execution.
Market order. A market order is an order that guarantees execution but does not guarantee the execution price. The final price depends on the available liquidity from limit orders in the order book. When you place a market order, it will search for the required volume at the best available prices in the market. For example, if the current price is $10,000 and you submit a market buy order, you only specify the trade size. With a market order, you cannot set the price. You simply enter the volume, such as 0.5 units, and confirm the order. The exchange will execute the trade at the best available prices in the order book. This means the trade will always be executed, but the exact price cannot be controlled. Market orders are useful when a trade needs to be executed immediately, either to open or close a position, and when the selected asset has sufficient liquidity. Liquidity is extremely important. If an asset has low liquidity and the trade size is large, the order may be executed across multiple price levels, resulting in a significantly worse average execution price. For this reason, when trading low liquidity assets or using large trade sizes, it is generally safer to use limit orders instead.
The order book. The order book is a table that displays all visible buy and sell orders placed by market participants. In simple terms, it represents the visible liquidity of the market. The main information shown in the order book includes price levels or price ranges. Prices are grouped into steps, for example, $50 per level, displayed both above and below the current price. For each price level or range, the order book shows the available volume and the total amount within that range. Limit orders are added to the order book, increasing overall market liquidity. When a limit order is placed, it remains in the order book until it is executed. Market orders, on the other hand, consume this liquidity. When a market order is submitted, it removes available liquidity from the order book, whether it is a buy or sell order. Liquidity represents the balance between supply and demand. The lower the liquidity, the higher the volatility, and the higher the liquidity, the more stable price movements tend to be.
How the order book works. The price of an asset is formed by the most recent completed trade, which occurs when a market order interacts with a limit order. Limit orders do not match with other limit orders on their own. Instead, a market order enters the market and removes liquidity from the order book by executing against existing limit orders. The price at which the most recent trade is executed becomes the current market price of the asset. An asset cannot be bought unless someone is willing to sell it, and it cannot be sold unless someone is willing to buy it. All orders are executed in a queue based on their order of placement.
For example, at a specific price level such as $18,650, there may be a total of 45 units available. This volume can belong to a single participant, an institution, or many different traders placing smaller orders. When a market order reaches this price level, the available volume is filled in sequence. Orders are executed in the order they were placed, following a first-come, first-served principle. The limit order that is placed first has execution priority. A trade occurs when a market order removes liquidity from the order book where all limit orders are stored. Let's now look at a simple example to see how limit orders and market orders affect the order book and the price.
Let's look at a simplified version of the order book. In the left column, we see the price levels at which market participants place their limit buy and sell orders. In the right column, we see the total volume available at each price level. This volume may come from a single participant or from many different traders placing smaller orders. Sell orders, representing supply, are typically shown in red, while buy orders, representing demand, are shown in green.
If we place a limit buy order for 30 units at a price of 10.8, the order book will change, but the asset price will remain the same.
This is because a limit order is added to the order book and increases available liquidity without immediately executing a trade.
By placing a limit buy order for 30 units at a price of 10.8 into the order book. As a result, we only see changes in the order book itself. Liquidity becomes denser, meaning that the available volume at that price level increases by 30 units. Now let's look at a market order example. Suppose we need to buy 100 units and we decide to place a market order. What happens in the order book? At this moment, there are 50 units available at a price of 11, 30 units at 11.5, and 30 units at 12. So what happens next? First, the price rises to $12. Why does this happen? Because the last executed trade takes place at that price, and the most recent trade defines the current market price. The market order first consumes the limit orders at $11, taking all 50 units at that level. Then it moves to 11.5 and takes another 30 units, bringing the total filled volume to 80 units. After that, the remaining 20 units are filled at $12. As a result, there is no remaining liquidity at 11 or 11.5, and only 10 units remain available at the $12 level. The entire order is successfully executed. This clearly demonstrates the definition of a market order. It guarantees execution, but it does not guarantee the execution price. The full volume is executed across a price range from $11 to $12, consuming all available sell-side liquidity within that range. Liquidity is one of the most important components of financial markets. When liquidity is low, price movements become more aggressive, and market volatility increases significantly.